Welcome to the Linehaul Playbook. I'm your host, Emily Blair. Joining me in my virtual studio today is Kawleski with Acrisure. Derek, thank you so much for joining me.
Yeah, thanks a lot, Emily. Appreciate it.
I invited you here today because I wanted you to talk to us about captive insurance. There is a program called Tango, and you are the expert. So, can you start us off by telling me how different is captive insurance from traditional commercial insurance?
Yeah, it's a good question, Emily. At its core, a group captive, which that is what Tango is, brings together best in class companies who join to form their own insurance company. In Tango's case, which was built for FedEx contractors, we worked alongside some of the most high performing TSPs across the country to create an insurance and safety solution that brings added value and I guess what I'd call optionality to FedEx contractors to help them better control costs and reduce insurance friction so they can, I guess, make more money, to be frank.
Well, I like that last part. Make more money is really good. How can it save you money?
So the real opportunity in a captive, and Tango specifically, is if you think about a traditional insurance company, each one of them, whether that's a Liberty Mutual, Acuity, Avant, each one of those insurance companies has a fixed expense. That number typically floats between 30 and 40%, and that number represents the money that it costs an insurance company to keep the lights on, to pay their insurance underwriters, to pay claims, to pay their actuaries. That's the number it costs to run the insurance company. The rest of that, let's call it 60%, is set aside for loss reserves, to pay claims for all the millions of clients and insureds they have across the country. Tango's fixed expense is 36%. So that means that's the expense to run the captive insurance company that we've built for the TSPs. That means the remaining 64% is the money set aside for loss reserves. That's the money we're interested in. And if you think about a high performing TSP and their loss ratio, meaning their losses divided by their premium, 30% is a number that a lot of companies would target. And so that means that if you've got a 64% loss reserve and you've got a company running about a 30% loss ratio, you've got an opportunity to capture up to 34% of your premiums in that case. And that is, in a lot of ways, the big carrot for captive prospects and captive members. The idea of chasing that underwriting profit and dropping that money down to their pockets versus the insurance companies.
Okay, that makes a lot more sense. Thank you for that explanation. So, would it be wrong to say it's almost use as you go, that you don't pay for what you don't use?
Yeah, I think in some cases, you're paying a premium that looks very similar to what you'd pay in a traditional marketplace. The idea, though, is if you're not using those loss reserves to pay your losses because you're outpacing the expected losses for your company, that is the opportunity to retain those earnings in the form of a dividend and creates, again, an opportunity to build an investment vehicle that you wouldn't otherwise have in the traditional insurance marketplace. In the traditional insurance marketplace, the money you spend on insurance is the insurance companies, whether or not you have a great year or a terrible year.
Okay. If you were to get a dividend back, would it be an annual type of thing that you would be able to perhaps get some of that money back?
In the case of our captive, you're going to see those dividends 3 to 5 years after the end of that policy year. And why you see captives wait 3 to 5 years is because in a lot of cases, there's open claims, right? There might be an open work comp claim, or there might be an open NTL claim following the end of the policy year. We need to see all those claims develop and ultimately close before we're able to provide a dividend back to any one of the TSPs. And so again, we're oftentimes waiting anywhere between 3 to 5 years to pay those dividends out.
Okay, that makes sense. And you brought up another question there. You were talking about workers' comp and NTL. What all coverage does the captive take care of?
Yeah, that's a great question because in the case of Tango, we built it to cover physical damage, work comp, and NTL. And that's very unique, as I understand it, across alternative captive solutions for FedEx contractors. My understanding in the marketplace is that there might be ones built for work comp only. This is a program built for work comp, FISDAM, and NTL, which gives you a larger premium pot to invest into the captive and ultimately hopefully return more dividends.
Yeah, definitely. That makes sense. That is very unique. So, who might be a good candidate for a program like Tango?
As I think about people that are interested in captive insurance companies, whether that's a FedEx TSP or anyone else looking into this model for financing their risk, it's really the type of business owners that are heavily invested in managing their risk. They're invested in data and technology to better understand their risk and make decisions around their risk and try to motivate behaviors to alter the improvement of their risk. So folks like that, folks who are interested in investing in themselves, folks that have been frustrated with maybe how the traditional renewal process has gone in that marketplace, those are the types of people that have typically gravitated towards captives. There's also a lot of folks that I think have just grown weary and fatigued by the volatility of the traditional insurance marketplace. I think terms like hard market, soft market are things that everyone's heard at some point in running a business and in talking to their insurance professionals. A captive provides an opportunity to kind of bend the curve on insurance costs and really feel like you own and take control of that spend. And so for anyone, big or small, that says that's me, those are the types of people we like to talk to because it could be you could be a part of a fleet that maybe isn't the size where the capital investment in a captive might make sense. We want to give those people an opportunity to learn about this model so that they might look at it and say, yeah, that's what I want to be when I grow up as I think about financing my risk and creating additional revenue sources for my business and my family.
Awesome. Those are great indicators. Now, you would have to be very selective in order to maintain this type of group, I imagine. What would be some indicators that you would not be wanting them to join the group? Does that make sense?
Yeah, I think so. As I think about people that might not be a fit, it would be, I guess, counter to what I described in thinking about people that might be interested, right? So if safety isn't at the forefront of what you do, if data and technology is not something you believe in as something to better manage risk, this isn't going to work, right? You need to position yourself, you need to bet on yourself so that again, we're outpacing loss picks and again dropping the money down to your pockets. Somebody that might be interested in selling their routes or their entire business in the next year or two, I don't know if something like this would make sense because there's some capital involved to get into something like this. So it's not a short-term play. I think buying insurance in the traditional marketplace can be a lot like dating, meaning you can kind of come and go as you please. You might spend a couple of years with that insurance company, and a couple of years later, you might find interest elsewhere. And so it's really easy to move in and out of insurance relationships in the traditional marketplace. I think when you're looking at a captive and you're choosing the right one and the one that's going to drive money back to you, you're looking for that marriage, and there's a different type of capital investment, and it's something you're in for the long haul because that's where companies really see the financial opportunity and upside is when you bet on yourself in the long term.
That's great advice. Thank you so much, Derek. I'm going to put your contact information in the description of the video. So if anybody wants to reach out to Derek and have a conversation, check there. You'll also be down at the Linehaul Summit in a couple weeks, correct?
I will. I'm looking forward to it. It'll be my first time down there in person. We're hosting a bourbon tasting table at the after party on Thursday night. So would love to see as many people as we can.
And well, I am looking forward to that. Thank you again, and we will see you at the Linehaul Summit.
Thanks a lot, Emily.